The video game industry is in a brutal contraction. Studios are closing, massive projects are being killed, and development costs are spiraling out of control. Public market investors have completely lost their appetite for hit-driven video game entertainment. If a studio spends 4 years building a game that flops, the stock gets punished and Wall Street moves on. Which makes it incredibly jarring that right in the middle of this downturn, a group of private investors is preparing to spend $55 billion to acquire Electronic Arts. Why would a consortium of buyers pay a record-breaking premium for a traditional game publisher exactly when the surrounding industry is collapsing? In September 2025, EA agreed to an acquisition that values the company at $210 per share in cash. That is a 25% premium over its unaffected share price. The consortium writing that check is led by Saudi Arabia's Public Investment Fund, alongside private equity firms Silver Lake and Affinity Partners. The proposed deal cleared a major regulatory hurdle on July 23, 2026, receiving approval under EU merger rules. This transaction is a take-private deal. If it closes, ordinary public market investors will no longer own shares, and EA will vanish completely from the public stock market. Being a publicly traded company means living in a 90-day pressure cooker, watching the market react instantly to earnings reports. Going private shatters that cycle. Without defending every short-term dip, a private owner has time to restructure completely. The consortium is relying on the existing leadership to execute that restructuring, confirming that Andrew Wilson will remain CEO. Privacy and a longer runway are valuable tools for a management team. But escaping the scrutiny of quarterly earnings calls does not mathematically justify a $55 billion price tag. The consortium is not buying EA with the hope of launching risky, unpredictable new art. The valuation is driven by specific, established intellectual property, namely massive annual sports franchises like EA Sports FC and Madden. Instead of relying on volatile revenue spikes of hit games, live services create a smooth, recurring revenue band. Buyers view these as predictable utility bills. Adding titles like The Sims and Apex Legends builds stacked layers of highly reliable cash flow. Wall Street and private equity firms justify the valuation by treating the company as a diversified portfolio of recurring entertainment commodities. But going private comes with a catch. This leveraged buyout is funded by immense borrowed money. Public stock is forgiving. If profits dip, the company survives. Corporate debt is relentless. It must be serviced with hard cash, on time, every month. A debt obligation does not care if a game is artistically ambitious or if developers need another year to polish the mechanics. It only demands yield. The operational freedom gained from escaping the stock market is immediately replaced by the ruthless, mandatory financial pressure of servicing a record-breaking loan. To keep up with those payments, management is forced to aggressively optimize and maximize their existing cash flow. On the product side, that translates to doubling down on the safest existing franchises and churning out high-margin mobile adaptations. For players, this pressure creates a dual threat: ruthless cost-cutting around experimental projects combined with a significant increase in aggressive in-game monetization. The financial structure of the buyout, the debt itself, directly dictates the creative boundaries and monetization mechanics you will experience on the ground. This highlights a critical flaw in the spreadsheet logic of a leveraged buyout. Investors tend to treat video game intellectual property purely as hard, extractable financial assets. But video games are highly sensitive relationships built on trust between the publisher, the creative talent, and the community. If debt-driven monetization pushes the audience too far, players will leave. And a publisher can own a famous brand, but still lose the exact creative talent needed to make that brand work. The PIF consortium carries the financial risk of the $55 billion transaction, but it is the developers and the players who bear the ultimate operational risk of the leverage squeeze.